Welcome to Breaking News to Trading Moves. Toyota literally invented the concepts of lean manufacturing and just-in-time production.
Right, they basically wrote the textbook on factory efficiency.
Yeah, the exact textbook every other global manufacturer studies. Yet the undisputed king of precision manufacturing is facing a fifth straight profit decline.
Which is pretty jarring to see.
It really is. So we are looking through a whole stack of financial data, production reports, and market analysis today. And our mission is to figure out what happens next.
Yeah, we need to figure out if these are just, temporary setbacks for the automaker or a broader decline in overall competitiveness.
Exactly, because the exact projections from the financial data we're looking at, they paint a very clear picture of the current headwind.
They do. Analysts expect Toyota's April to June operating profit to fall about 5% year over year.
Which is a pretty massive chunk of change.
It is, yeah. That brings the figure to roughly 1.11 trillion yen. And when you look at the physical output in the actual cars rolling out of the factories, it's down too.
Global sales for Toyota and Lexus declined 3%, right?
Yeah, coming in at just over 2.5 million vehicles. The ticker we were watching here is TM.
Right, TM. And those numbers represent a massive global footprint. Falling profits and falling sales don't just happen in a vacuum.
No, especially not for a company this size.
Exactly. We are looking at a combination of three distinct pressures hitting them all at once. First, there's weaker overall demand for their vehicles across several key regions.
Right, which is a big problem on its own.
Yep. Second, they are dealing with higher material costs, which just eats directly into their profit margins on every single car they sell.
Margins just get squeezed.
And third, they are managing severe production stoppages. Specifically, they had to suspend operations at 4 of their Japanese plants following an earthquake in Japan.
Right, they had to pause while suppliers assess the physical damage. And we really have to categorize these pressures accurately to understand the true threat to the business.
Makes sense. How do we break those down?
Well, an earthquake is an acute event. You assess the damage, you repair the factory lines, and you turn the machines back on. The timeline is, generally predictable.
Okay, so that's the acute part.
Exactly. But weaker demand and rising material costs are systemic pressures. They require a change in strategy, a change in pricing, or a change in the actual product lineup to resolve.
And navigating those systemic pressures takes much longer than just fixing a broken assembly line.
Way longer. It's a completely different kind of problem.
Well, that brings me to a specific number in the regional breakdown that stood out. Within that overall global sales decline, there was a 28% drop specifically in China.
Yeah, 28%.
I mean, 28% is a massive chunk of revenue to lose in one of the world's primary consumer markets. So is the earthquake stoppage just masking the reality of that 28% drop in China?
That is the exact question investors are asking right now.
Let's look at the winners and losers here. I was reading through the sales breakdown, and it seems this isn't about the Chinese consumer not wanting cars.
No, they definitely still want cars.
Right. They are actively choosing local electric vehicle brands over legacy foreign brands. Companies like NIO, ticker NIO, and XPeng, ticker XPDV.
Yeah, NIO and XPV are gaining ground really fast.
And it seems like it's because they operate more like tech companies than traditional car makers, right?
Exactly. The domestic electric vehicle brands in China treat the car as a software platform first and a hardware platform second.
So it's basically a smartphone on wheels.
Pretty much. They push out over-the-air software updates, refine user interface features, and roll out new digital iterations at a pace legacy automakers just struggle to match.
Because a traditional automaker often takes up to 5 years to design a car, test the aerodynamics, and retool a physical factory floor for a new model.
Right. It's a massive, slow process. But NIO and XPeng benefit from utilizing localized technology that appeals directly to the domestic consumer's preferences.
Coupled with those much faster product cycles.
Exactly. And they also offer highly competitive pricing because their supply chains are entirely local.
It just changes the entire consumer expectation. If a buyer knows they can get a car that updates its own software every month,
then a traditional vehicle that stays exactly the same for 5 years feels totally obsolete the minute they drive it off the lot.
Wow, yeah. Toyota's decline really illustrates the intense pressure foreign manufacturers face when trying to compete on foreign soil against agile domestic EV brands.
The numbers absolutely validate that consumer behavior. If we continue to see weakness in Toyota's numbers in that region, It just reinforces the view that NIO and XPeng have secured the upper hand.
The Chinese consumer is basically voting with their wallet.
Right, preferring the domestic tech-forward approach over the legacy internal combustion engine models.
But, that competitive pressure isn't contained to Asia, though. Let's bring this back to the U.S. market.
Sure, because Toyota is fighting a distinct battle happening in the crossover and SUV space here in North America.
Exactly. We are looking closely at General Motors, ticker GM, and Ford Motor, ticker F.
Yeah, GM and F. And the context here is that Toyota is currently transitioning from the outgoing RV4 model to a newly redesigned version.
Right. And a model transition is inherently the most vulnerable time for an automaker, isn't it?
Oh, absolutely. The physical assembly lines have to be modified. The inventory of the older outgoing model is intentionally winding down, and the new model is just slowly ramping up production.
So the total volume of cars available for dealerships to sell naturally dips during this window.
Right. And then you add unexpected factory stoppages from an earthquake onto that timeline.
Making the risk to vehicle availability pretty severe.
Exactly.
It honestly reminds me of a popular local restaurant running out of its most famous dish. Customers won't wait around for the kitchen staff to go to the store and get more ingredients.
Right. They will just walk next door and eat somewhere else.
Exactly. In this automotive scenario, a prolonged shortage of RAV4s could easily increase showroom traffic for GM and Ford.
Yep. Those domestic automakers can capture that frustrated foot traffic without having to spend an extra dime on marketing or advertising.
They just have to have the cars available when Toyota doesn't.
And General Motors and Ford have competing Chevrolet, GMC, and Ford models sitting on the pavement, ready to be driven off the lot today.
And capturing that frustrated foot traffic translates directly to market share gains in the short term?
Right. I mean, the American consumers generally brand loyal, but convenience and immediate availability often trump brand loyalty when someone desperately needs a new vehicle for their commute.
So while Toyota resolves its availability and factory issues, GM and Ford have a clear runway to close sales they otherwise would have totally missed.
That's the reality on the showroom floor right now.
Okay, so we have the EV makers winning in China and the domestic legacy automakers potentially winning in the U.S.
Yep.
Let's pivot to the material cost pressures we mentioned earlier. Higher prices for raw materials are actively squeezing Toyota's profit margins.
Which brings us to the aluminum producers.
Right. We are specifically looking at Alcoa, ticker AA, and Century Aluminum, ticker CENX.
AA and CENX. And logically, the very environment hurting the car makers' margins is supporting the companies pulling the metal out of the ground.
Because modern vehicles require a substantial amount of aluminum to meet fuel efficiency standards, right?
Oh, definitely. We are talking about hundreds of pounds per vehicle used for body panels, engine blocks, and wheels, simply because it is lighter than steel.
So when the price of that raw material goes up on the commodities market, the physical cost to build the car goes up.
Exactly. Automakers often absorb that cost initially rather than raising the sticker price, which compresses their profit margins.
And this dynamic currently supports the revenues for Alcoa and Century Aluminum. But explain the mechanics of this, though.
Sure.
Because I assume there is a delicate balance here. This has to be an indirect trade.
It is, yeah.
If supply constraints and higher material costs force automakers to reduce vehicle production over a longer period, they are ultimately going to buy less aluminum from these producers.
You nailed it. The commodities market tracks auto manufacturing schedules relentlessly. Weaker vehicle production eventually reduces the overall demand for raw materials.
How does that actually work with the contracts, though?
Well, automakers purchase aluminum through long-term futures contracts. If a major global buyer like Toyota starts extending plant shutdowns and building fewer cars, their future orders for aluminum drop.
Ah, okay. So the spot price of aluminum might be elevated today, boosting current revenues for the miners.
But if your biggest industrial customer stops building cars next quarter, the producers will face a sudden drop in demand.
That is a tough spot. You have to monitor how long the automakers can sustain those higher costs before they simply reduce output to protect their balance sheets.
Exactly. This is a very delicate balancing act.
So we have thoroughly explored the companies gaining ground. Now we need to flip the perspective and look at who is feeling the strain alongside Toyota's headline struggles.
Right. And the most direct potential loser is Toyota Motor itself, ticker TM.
Yeah, Kiem. The market is watching the executive management team very closely right now.
They absolutely are. If they come out and cut their forward earnings guidance, or if they announce that the plant shutdowns in Japan are being extended by several weeks, the shares are highly vulnerable to a sell-off.
And investors are specifically watching how management frames the situation in China, right?
Oh, that's the big one. If executives declare that the 28% drop is a structural problem, meaning a permanent loss of market share to domestic competitors, rather than a temporary delay in purchasing, that alters the entire investment thesis for the company.
So the market would price in a permanently smaller footprint in a vital region.
Exactly, leading to a downward revision of the stock's value.
That makes logical sense for Toyota. But what about their peers? I'm looking at Honda Motor, ticker HMC.
Yeah, HMC is an important one to watch.
They didn't have the same earthquake stoppages, so their production lines are running. Why are they on the loser list?
This involves a market mechanic called sympathy selling.
Sympathy selling.
Yeah. Institutional investors in algorithmic trading models often group companies together by geographic region or specific sector.
Okay, and Toyota is the largest Japanese automaker.
Right, acting as the bellwether for the entire country's industrial output. When Toyota reports severe struggles with material costs and market share in Asia, investors become cautious about all Japanese supply chains.
Wow. So even if Honda's operations are running perfectly smoothly today, an investor looks at Toyota's earnings report and assumes Honda is facing the exact same macroeconomic headwinds.
Exactly. It raises doubts about the ability of all established Japanese manufacturers to defend their market share against new competitors.
So investors sell off Honda shares in sympathy with the bad news from Toyota.
It is basically a guilt by association dynamic.
That is wild.
The market assumes that if the industry leader is struggling with aluminum costs and Chinese EV competition, the second-place player is likely suffering the same fate, even before they release their own financial reports.
And that fear of a Japanese auto slowdown doesn't stop at the brand level either.
No, it goes much deeper.
If investors are dumping Honda shares out of sympathy, the companies literally building the engines and parts for these cars are facing very real physical order cuts.
Right. We have to look at the global automotive suppliers, focusing on Magna International, ticker MGA, and Borg-Warner, ticker BWA.
MGA and BWA.
Yeah. Automotive suppliers operate on strict economies of scale and highly predictable order flows from the major automakers.
Furthermore, they operate on the exact just-in-time manufacturing principles we discussed earlier.
Exactly. Because Toyota doesn't stockpile massive warehouses full of parts to save on storage costs, suppliers like Magna and Borg-Warner don't stockpile massive warehouses of finished components either.
Right. The parts are built and put directly onto a truck heading to the assembly plant.
Which means the mechanical reality there is fascinating. If Toyota suspends 4 plants, Magna and Borg-Warner don't just get to take a long weekend.
The supplier's assembly line backs up almost instantly because there is no warehouse buffer to absorb the extra parts.
Precisely. The suppliers are forced to idle their own production lines.
And they have capital tied up in raw materials, but no finished product leaving the shipping dock to generate revenue.
You cannot just turn a massive parts factory on and off like a light switch without incurring heavy operational costs.
Yeah, workers still need to be paid.
Right. Machinery needs maintenance, and overhead costs continue to accrue while the line sits still.
It creates an immediate inefficiency in the supplier's own manufacturing process. And it isn't just the immediate loss of revenue from those missing orders.
No, the broader fear for the suppliers is tied to Toyota's status as an industry bellwether.
If Toyota is purposely slowing down output due to weaker consumer demand, it signals a wider automotive slowdown.
Exactly. Those suppliers face the very real prospect of order reductions from their other automaker clients as well.
We are talking about lower volumes for everything from basic interior components to highly complex powertrain systems.
It's a tough position to be in.
And that supply chain disruption trickles all the way down to the final stop in the life cycle of a car, right? The dealership lot.
Absolutely. We are looking at dealership groups with heavy Toyota and Lexus exposure.
Specifically, AutoNation, ticker AN, and Penske Automotive Group, ticker PAG.
AN and PAG dealership groups are the front line of the automotive industry. They're the ones who actually had to look the customer in the eye and tell them the car isn't available.
Which is never a fun conversation.
No, it's not. They are heavily affected when popular vehicles become harder to source.
Let me push back on this point, though.
Sure, go ahead.
AutoNation and Penske are massive national publicly traded operations. They sell dozens of different vehicle brands across hundreds of geographic locations.
Very true.
So do massive diversified dealership groups really feel the sting of one single brand's supply issues. I mean, if they don't have a Toyota Camry available, they can just walk the customer over to the Honda or Ford lot they also own right next door.
It's a fair question. Their brand diversification is certainly their primary defense against a single manufacturer's supply chain issues.
Wait.
However, you have to look closely at the financial mechanics of dealership profitability, specifically a concept called floor plan financing.
Okay, how does that work?
Dealerships do not buy their inventory with cash. They take out specialized short-term loans to purchase the cars they put on the lot.
Oh, I see.
They make their profit on inventory turnover, selling that car quickly to pay off the loan and capture the retail margin.
So every single day a car sits on the lot, it costs the dealership money in interest payments on that floor plan loan.
Exactly. Plus physical storage and insurance costs.
And Toyota and Lexus vehicles are historically high-demand, fast-turning inventory.
They sell quickly, which keeps the dealership's financing costs low. When those specific popular vehicles become harder to secure from the factory, it creates a revenue bottleneck.
Because a customer who wants a specific Lexus hybrid might not want to be walked over to a different brand.
Right, they might just decide to wait 3 months or hold on to their current car longer.
And the dealership loses out on the immediate revenue of that sale.
Yeah, but they also lose the financing kickback from arranging the customer's auto loan. And they lose the potential trade-in vehicle they could have acquired, reconditioned, and flipped on the used car lot.
Wow, so it's a compounding effect. Reduced availability of a major profit driver like Toyota or Lexus slows down their overall inventory turnover metrics.
It creates a direct, albeit temporary, headwind for AutoNation and Penske.
The disruption to their quarterly cash flow is a tangible metric that investors watch, even if it doesn't threaten the stability of the entire enterprise.
Exactly. It's a notable drag on the quarterly performance.
Well, we have covered a lot of ground today, looking closely at the manufacturing floor mechanics, the commodities market for raw materials, the overseas competitors, and the financial reality of the showrooms.
It's a massive ecosystem to track.
Let's synthesize all of this back to the core question for the listener. Are we looking at a temporary blip or a structural reality? What is the bullish case here?
Well, the bullish case hinges entirely on a quick resolution to the immediate operational hurdles.
Okay.
If Toyota can achieve a rapid production recovery from the earthquake stoppages, and more importantly, if management firmly confirms their full-year profit guidance during their next earnings call, the narrative changes entirely.
It tells the market that the bad news was contained entirely within this specific quarter, and the ship is already correcting its course.
Right. Confirmation of full-year guidance signals to institutional investors that they expect to make up for the lost time and lost sales in the coming months.
So they plan to run the factories harder and push more inventory to the dealers to meet their original targets.
Exactly. And that supports a relief move upward in TM shares.
Logically, it also reduces the downward pressure on the suppliers like Magna and the dealership stocks like AutoNation as order flows and inventory levels normalize.
Yes, the whole chain recovers together.
But we also have to respect the bearish case. What happens if they can't confirm that guidance?
If management issues a guidance cut, if the plant shutdowns are extended further into the quarter, or if we see continued sustained weakness in the China sales numbers, the bearish case for Toyota strengthens considerably.
It proves that the issues are not just a temporary geographic pause caused by an earthquake, but a structural loss of momentum and consumer demand.
And that structural loss for Toyota directly supports the thesis for the winners we discussed.
Prolonged weakness for the legacy automaker validates the market position of the U.S. crossover manufacturers like General Motors and Ford picking up the slack in North America.
It certainly validates the Chinese electric vehicle companies like NIO and XPeng capturing the tech-focused consumer in Asia.
It paints a very clear picture of how hyper-competitive the global automotive space is right now. A slight stumble by one giant immediately provides a foothold for 3 others to climb higher.
It really does. And looking specifically at those sales numbers from China, I want to leave you with a final thought to ponder.
What's that?
We discussed the mechanics of how domestic Chinese EV brands, utilizing local technology and incredibly fast product cycles, managed to cause a 28% sales drop for a legacy manufacturer like Toyota within Chinese borders.
Right, which is just a staggering number.
The question you have to ask yourself is this. If those domestic brands can exert that kind of pressure on a dominant player on their home turf, what happens when those exact same local brands successfully scale their operations, build shipping infrastructure, and bring those highly competitive prices into global markets?
Please note this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.